Hello, and welcome to The Relationship Edge, a podcast where we explore the power of relationships in the private markets. And I'm joined today, actually, by my special guest, Dave Lambert, co-founder and general partner at Right Side Capital Management. Dave, thank you so much for joining us today.
Thank you. Happy to be here.
We're really excited to have you. Place I figured we start with is that your team has a fairly unique strategy around how you think about pre-seed investing, particularly like a very data-driven and quantitative strategy. And so I'd love to start with what led you down the path of identifying that strategy, believing it was viable, and that it was worth pursuing in the first place.
Yeah, I mean, it was really the late 2000s. We were looking at the venture space as a whole, and at that time we saw that venture capital firms returns had sort of fallen off a cliff in the 2000s after being very strong in the 80s and 90s. We thought angel returns were a little higher, and we did some looking into it, and they were sort of investing into different fundamentals, at the onset and exiting differently. Like the low value tech M&A market had really exploded on the scene in the mid to late 2000s. And angels were able to take advantage of that, and VC firms not so much. So we sort of started thinking there, and then we were aware of sort of power law and power law math, back in the 2000s, even though it was sort of a more obscure part of the math world then. And we just realized that to smooth out the risk curve at this very early stage where you wanted to invest, you needed a lot of diversification. More that can be done with sort of the traditional investment methodologies, because those were just way too labor intensive. So we started just thinking, how could we create these ultra diversified portfolios? And we thought, hey, we'd need to have some data driven, quantitative, sort of algorithmic approach so that we can make very quick yes no decisions. So it's really all self-interest. We wanted to have these ultra diversified portfolios, and you can't evaluate a company subjectively for months before making a decision and do that. And that's what led us down this road.
Yeah, it makes sense, especially given that the pre-seed company may have only been around for a month or two when you first started engaging with them in the first place. So you probably have limited data to go off of regardless.
Yeah, especially then. When we started investing, most of what we invested in was still pre-revenue. In today's world, it's different. Most of what we invest in has revenue already, so there's a lot more data to analyze. So the data we look at is a little different, but it's all about what pieces of data can we gather up and make a quick decision on.
Yeah, it completely makes sense. And given that strategy around diversification, it sounds like it's also a very broad portfolio. And so you guys are investing in, as I understand it, hundreds of companies over the course of a year, or maybe in that range.
Yeah. We have over 2,000 investments since 2012. So yeah, lots of companies. The scale of both our sort of portfolio ecosystem is enormously large, and also our sort of investor network has to be very large, because we need to help facilitate our companies get introductions to later stage investors at sort of every stage, because we have companies at every stage in the life cycle.
Yeah, totally. And I guess given that, just given the breadth of the portfolio that you're describing, 2,000 plus companies, and the scale at which you invest, you probably have a pretty unique purview into the state of the early stage private markets as it exists today, particularly across the entirety of the U.S. and the world versus others. And so if you had to pick one or two things that you're seeing that you think the venture markets or other early stage VCs don't appreciate or don't particularly value from your purview, what do you think those would be?
It's a tricky thing to answer because it changes over time a bit. But I would say the thing that is that we're one of the areas where we're the most different than traditional venture firms, even very early stage ones. One is, I think most investors that are looking to evaluate a company are trying to predict if that specific company will succeed or fail. And we sort of have a philosophy that at these incredibly early stages, you just can't do that. There's too many variables of uncertainty. So we're really turning a company into a profile, and we're trying to ask ourselves, would a pool of a bunch of companies of the same profile at the same price perform well? And if it would, we're investing, but we don't feel we can predict how any specific company will perform. So I think that's philosophically a huge difference. Then I think the second thing that we do fundamentally differently is most of the venture world has this very intense focus on the percentage ownership that they have of a company, and they won't even make an investment if they don't sort of hit their minimum ownership requirements. And we don't actually factor in ownership at all from the perspective of our new investments. All we care about is what we think our projected return multiple could be, and it doesn't matter if we're starting with 2% or 10%. If we think it's a very attractive sort of distribution curve that'll give us a good return multiple, we're investing.
Yeah, it's really interesting. And I'm guessing those kind of play together a little bit in that, if you are making a bet on the profile of company and the scale of the companies that maybe match those profitable profiles, then you maybe don't feel as much of a need to maybe double, triple down in like particular winners or something like that. Is that the way to think about how those things play together?
Yeah, we generally don't do. Yeah, we break most of the perceived best practices of venture, so we don't generally do. We don't do follow-on investing. Don't take board seats. We're ultra diversified, very quick decisions. Sort of like a lot of things that are just sort of different than how most do it. But yeah, I mean, I think the other thing that's was different for us for 10 or 12 years and not so much anymore because the world's changed is us being much more price sensitive. So a lot of our things are not, do we think this company will profile's attractive and not consider price. Like in our DNA, the price matters. It's at this price. So we might have a company that we think is very attractive and it might be attractive at a $3 million valuation, but not at a 5. Whereas I think most of the venture world up until just a couple years ago, that was sort of viewed as sort of an irrational strategy because the view is that early stage venture is binary. The company is either wildly successful or not, and getting into that crazy successful company is what matters and not your price. And then I think that was sort of the belief up until early 2022, and now there's just this massive attention to valuation suddenly. And it'll change. The VC world's very cyclical. So there's an incredible attention to valuation at all stages of venture right now. And if we go forward 2 years from now, there probably won't be so much. And then at some point, another bubble will form. It's just how it always works.
Yeah. It's to your point. It's a differentiated strategy, but as described or as makes sense, there's value in the differentiation, right? Taking a very different strategy leads to different.
Yeah, and something you just said I think is incredibly important. I think the venture world is just substantially different than it was in the 90s, 2000s, early 2010s. There just weren't that many players in it, and it was a much more sort of inefficient, dysfunctional market. And now there's so many active participants, both investors and entrepreneurs are so networked and can get so much information just online or subscribing to certain platforms about the other side that it's turned into much more of an efficient market. So if, as an investor, I think it's really difficult to make outsized returns consistently over a period of time if you're doing what everyone else is doing when a market's becoming more efficient. So I think it's more important than ever for investors to have, there's got to be something about your strategy or something that you're doing that gives you some edge, where you're doing something substantially different or of a different view. Contrarian views tend to be the ones that outperform, for extended period of times. Otherwise, excess returns get arbitraged out. And I think the venture world's going through sort of that painful, slow experience over time. And I think private equity as well.
Yeah, it's the old Howard Marks 2x2, right? Contrarian and right. And so, contrarian's necessary, and right also is important. And it sounds like you guys.
Yeah. It's hard to predict when you're right or not. But if a company you invest in, just even as an example that where it's going to a hot area that everyone agrees is a hot area, you're going to have massive competition. Sort of out of the gate, you invest in something, turns out that most people think it's crazy and it succeeds. It could have a couple years of no competition. And maybe you got it at a cheaper price because everyone else thought you were crazy for investing in it, right? So it's much easier said than done because sometimes it's scary or feels very odd when you're going against the stream of sort of conventional wisdom.
Right, but as you described, it also gives you the opportunity to be massively right, and so there's definitely pros and cons.
Yeah. It's just like there's the old. I think it's a Warren Buffett saying, you want to be greedy when everyone else is fearful. And I think every investor out there, in good times, if you ask investors, do you have what it takes to be greedy when everyone else is fearful? Almost everyone says yes, they think they are that. And then when it gets really scary, everyone's like, holy cow, this is scary. And you realize I'm just as scared as everyone else, and it's really hard to do that. It's not the case that you're suddenly not scared when everyone else is. It's that you're scared and you realize that, hey, that can sometimes make it more opportunity. Now, I don't think we're not scared when we're making our investments, but you have to have sort of this confidence that, all right, in our example, and I think in a lot of the venture world, that you're doing something substantially different because you think you've identified some segment of the market that's undervalued or some process or way of doing things that gives you an edge. And you've just got to have confidence and believe that if you think that's true. And if everyone else thinks you're crazy, that's good because you're going to have that edge for longer. Like, that's our view.
Yeah, makes sense. It all returns back to conviction in one form or another.
Yeah, and that's true for an entrepreneur too, because when you're an entrepreneur, you get so much crazy advice all over from investors, advisors, all of this. And everyone at first says what your startup idea is, there's no chance it'll work because it's crazy. Because if it was so obvious, everyone would be doing that. So like, you just have to have this faith and this belief in what you think, even if a lot of others think you're nuts, both sometimes almost always as an entrepreneur and often as an investor. The challenge is you have to both do that and always search out people that have more knowledge and expertise and be learning at the same time. And it's a delicate balance. You can't just blindly think you're always right and everyone's wrong. So it's a delicate act of confidence and always trying to learn. Because I mean, I feel like I've been as a tech CEO for 2 decades. I've been an investor, investor on and off, angel investor in the 90s, 2000s, venture investor for 15 plus years. And I'm still always learning, right? The world always changes. You always meet people that know more, know things that have had different experiences you can learn from. And you just got to always keep learning.
No, absolutely. I mean, speaking of world changing, right? So in the moment, what we're all experiencing is just an incredible shift and incredible set of advancements as far as the capabilities of artificial intelligence. Your major at Stanford, it seems, was centered around how changes in technology, and maybe even particularly AI, like impact society and how that loop kind of impacts itself. I guess given that background, any underrated impacts of these AI advancements on how we operate as a society that we should be thinking about would be really interesting to hear.
It's so hard when changes like this come along. Society is changing so much more quickly, every year. We just get used to it as humans. Our brains are wired to accept and handle change pretty quickly. But one thing I've learned as an entrepreneur investor is it's so hard to predict how that change comes. Like the thing that I learned in the 90s and 2000s, things that people often said were just a few years away took a decade plus, and things that people thought were ages away from happening suddenly just get solved and happen, quickly. AI is very similar. The changes are going to be faster than people think. Some areas it'll be projected to be very disruptive. It won't be as disruptive. Some areas will just get disrupted quickly. In the startup world right now, the biggest thing that we're seeing, where it's just sort of life-changing at our stage, is that one of the things we've taken advantage of as a firm over the last sort of 12 to 15 years, being in the right place at the right time, is that it's gotten cheaper and cheaper to build a first version of a software product every year, going back to the early 80s. But I think that sort of really started falling off a cliff from like 2010 onwards. But it was never the case that the cost to scale a business got any cheaper, scaling up sales, marketing, customer support, all this stuff. But AI coming along, young companies are embracing AI tools for operational efficiency gains. And suddenly now, in the last 12 to 24 months, all these operational things can be done much more efficiently. So suddenly it's not just cheaper to build a product, it's cheaper to do sales and it's cheaper to do marketing when you're using AI tools and customer support. And that's just the biggest shift, I think, that we're seeing right now at these very early stages. It's not just companies that have AI in their product. Like, that's going to become table stakes just very shortly. But I don't think, people outside of the space appreciate how it's changing the sort of operational structure of companies. Will we need these mega rounds that were happening in the 2019, 2020, 21 series, massive series B, C, and D rounds? Will we need as many of them when companies can do so much more with less employees? I don't know, but it's going to be very interesting to see. It won't surprise me if less of them are needed.
Yeah, to your point, even just thinking about as you described, the operational improvements and what that means for the amount of headcount it takes for companies to scale and what form that headcount takes, like we're seeing all that shift in real time, like within our ecosystem. And, I start to think about plenty of other industries that have a lot of, whether it's service-based or intellectually based work that, these LLMs can do at a pretty high level today, and the pace at which they're improving become, even more powerful. And I can certainly see the opportunity for like the shape of society to change really dramatically. But as you described, the specific pockets where that happens, like hard for me to predict for sure.
Yeah, and there'll be massive growing pains, both in the tech world, investment world, societally, culturally. We're just going to have a lot of culture shift, a lot of economic upheaval, and even if we end up in this great spot a few decades from now, it'll be a painful transition because it always is. Society and regulation and everything moves much more slowly than change, always.
Yeah, yeah, absolutely. I want to return to the scale at which you operate, and maybe in particular the scale of the relationship network that you need to maintain. It sounds like maybe both for the purposes of helping access downstream capital, but probably for many other purposes as well. I guess first I'd love to hear, what would you say like the single biggest win or opportunity as an investor, or maybe with some of the companies that you work with, that you can trace back to your network and your relationships across the firm?
Boy, our single biggest it's hard to even say that it was relationship based. I think, now as we look back over the last many years, like we're able to, the network effect's really crazy. So like one of the things that we haven't done, that a lot of early stage investors do is we don't take board seats and roll up our sleeves and try and operationally impact, like as a board member, the companies that we're investing in, because we could not be on that many boards. Like that's all we'd be doing. And so that doesn't work. So everything that we've built out is what's the value that we can add by leveraging the scale and network effect of our portfolio and of our investor network and of the number of deals we do. So it's just about delivering value and insight differently. So for example, whether it's today or whether it's 2018, I could be talking with a founder and they might say, I ask them what their fundraising roadmap is, and they might say, hey, we're looking to go out and raise a $2.5 million round at a $10 million valuation. And we've got so many data points because we see so many rounds getting done in our portfolio, and we have this data that other people just don't have. I can know almost instantly, hey, that's great. Let me connect you to the person inside our firm that can get you your deck and your information out to our investor network. Or I just might say, I think you only have a 10% chance of getting that round done. You don't have the traction relative to your sort of geography and business model that'll get a round like that done. You should be raising $1 million at 5 instead. That's what's realistic. And I think just we have that data point based on business model, geography, traction, all this that a lot of other people don't have, because the early rounds that we're doing, and sometimes even these pre-seed rounds, like the data is old or it's not there for different markets and stuff. So like that doesn't take much time at all to deliver, but I might have just saved that company by giving that 20 seconds of advice. Or best practice sharing, or, I just got off a call this morning with a company that had a funding round blow up in just sort of a crazy way and unusual, and I can't sort of describe it, but we had another company in our ecosystem that had almost the exact same thing happen just 4 weeks ago, and I was able to connect those two CEOs together. And it's just leveraging the scale and network effect. Because almost any weird thing that happens, we've had it happen to other companies before. And so you can learn from best practices, other people's experiences. And so, really how we've built ourselves up is we're structured like an operating company. So, the traditional private equity venture operating model is you've got a partner or 6, and they're the luminaries that pick the investments, sit on the board, sort of bring their personal network to help improve the value of those companies. And we're not structured like that at all. We're more like a tech startup whose business is funding other tech startups. So internally, we're just like an operating company with different business units, and that can handle things at scale, whether it's giving operational support to companies, fundraising support, unusual advice support, help, you name it. We just break down and look operationally very different.
Got it. Yeah, no, I certainly haven't heard of that sort of construct or model before, but it makes sense that you would operate differently given the scale at which you operate.
Yeah, and then we try and make it, because of that, we try and make it so that everything that everyone's doing, there's no person that's sort of a single point of failure, where they're the only person that knows how to do that or can do that. So if someone got hit by a bus, it would be painful, but we would have other people that could step in and do that. And that's a little harder when it's this sort of traditional partner style, because if you have 3 partners and maybe that one branded illuminating partner gets hit by a bus, well, your firm might be dead.
Yeah. You kind of built it really maybe as a result of the scale at which you operate. You're almost forced to have everything be more of a system, and that does maybe distribute risk.
I would also say that's harmed us too. Like, while that's been good for us operationally, I think that's hurt us from a fundraising perspective, because we have never really tried to promote the brand of any of the sort of founders, managing directors. In hindsight, probably in the 2010s, if we could do it all over again, we probably would have focused more on picking one of us and building a big brand. In both the, the LP world, VC world, and all that, because I think investment follows perceived luminaries much more than it will follow a system or process in the venture space. Again, learnings, it's easy in hindsight to know, and that's what you've done differently. It's harder in foresight, just the same thing for our startups. It's like, I get a lot of our CEOs who are just kicking themselves for some mistake they made, or they made a wrong decision, and we're often saying, hey, it's really easy after the fact to know it's a wrong decision. It's not so easy in foresight.
Oh, trust me, I got the list, so I'm right there with them. I understand for sure. No, that's all really kind of interesting, as you described, like a very different structure. With that list of, I think you mentioned, over 1,000 downstream investors or others that you're maybe helping companies with fundraising or getting in front of, how does a team go about just harnessing, managing that network of so many investors or so many funds?
So what we do, the reason we're able to do that is because we've got a large enough portfolio that we actually have a person that full time is doing mostly that. And we use a lot of technology, some AI tools, and it's not just that we collect a list. We collect a list, we have ways to, either we're having phone calls or emails or follow-ups to stay on top of, because some investor at this point in time might be investing in $4 to $6 million rounds in these 3 sectors, but 9 months later, it might be 2 of those 3 sectors might have changed, or maybe they're going up or downstream. So you got to sort of always be on top of it. And then we're logging it. We're not doing it by memory. We've got databases and systems and processes. So when we get a company, whether they're going for a $2 to $3 million pre-seed round, or it's a $20 million Series B, we can enter in some data and we get out large lists of potential investors. And then we work iteratively with that company to try and screen out any they think they don't want us to reach out to, things like this. And then when you do that, it turns out you're generally sending out companies to investors that's in their wheelhouse. And even if it's a no or they don't want to see it, they really appreciate that curating and that it's fundamentally a good match. And then that makes them look at your emails more and pay more attention to what you send them. So, we've gotten a lot of feedback back from our investor network that we do a great job of that curation and sort of what we're showing them. Also, the nice part of this for us, too, is it gives us a real pulse on how the fundraising markets are going. So, we have a really good feeling for how just really impacted and distressed the venture capital world is, because we see, emails bouncing back. We see firms going out of business. We talk to people who are like, oh, we're not investing for the rest of the year, or all of this. These are just conversations and things or happenings that just didn't go on in the 2010s when the venture world was expanding, and it's all happening constantly. That evolution over the past, particularly 12 to 24 months, it's as stressed as it is for the startup world right now, it's probably more stressed for the venture world for fundraising.
Yeah, no, it's really interesting. In some ways, you almost have an internal version of Carta Insights or something like that, just given the scale of these conversations at the venture side and on the founder side. That's all. It's the benefits of scale give you all sorts of other kind of downstream things that are really cool.
Yep, exactly.
Yeah, fantastic. Well, I know we're starting to get towards the end of our conversation here. I'll ask you maybe our traditional closing question, which is, what do you think is the single biggest lesson that people get wrong around relationship building, relationship management, or just the private markets in general, that you think more folks would do better to better understand?
Boy, I don't know how much they'd better understand, but I just think ultimately the world revolves around relationships much more than it does around contracts. And it's a smaller world than people think, and things come back, around. And in the early stage venture world, relationships and social currency matters a lot. I think as you get to later stage venture and private equity, it's a lot more Machiavellian. So it's sort of a different world. But yeah, it's our view is it's often you want to have what's written and papered, protect you, but it doesn't almost matter what's on there. If someone wants to screw you, they're going to screw you. So people and relationships just matter, and I think that's stuff that I discovered both as an entrepreneur and CEO for almost 20 years and as an investor.
completely makes sense.
And it's
to
not
me.
shocking news. That's not anything super controversial, but I just feel that way more and more as time goes on.
Yeah, I think it's one of those things that people wouldn't say is controversial, but the degree to which it is true is almost always surprising.
Yeah, exactly.
Well, Dave, thank you so much for the time and for all of your insights today. If anyone who's listening or watching wants to learn more about you, Right Side, maybe follows you all more closely, where can they find you?
Yeah, they can obviously our website, which is rightsidecapital.com. If you have any questions or want to reach out to me directly, feel free to email me. It's dave@rightsidecapital.com, and we're always happy to talk.